Any investor who's putting in money, they want to understand the risks attached to the business. And that led to a huge reduction in the valuation of the company that it was being raised on. They have to be mentally prepared of what kind of valuation they're looking at.
Hi guys, you are watching Grip Invest, and today we are back with yet another episode of Cut the Noise, and we have Ankit Dukania with us, Head of Finance at Grip Invest. So first of all, Ankit, thank you so much for joining us and taking your time out.
Thank you, Megha. I'm very happy to be here.
So Ankit, recently we are seeing that very few startups are getting funding this season, but Grip bagged the $10 million in Series B round. So how do you feel about it?
It feels very good, Megha. It also goes on to prove that what we're building here at Grape, the investors as well as the customers value that. So it's a good validation to what we are building here. So yeah, definitely.
And I'm seeing that since last 6 months we are doing a lot of exercises, especially on the due diligence. And what do you think that why this due diligence is so important for any startup funding?
Let's understand what due diligence is. Any investor who's putting in money, they want to understand the risks attached to the business. So there are two types of due diligence. One is legal, which is more focused towards what kind of products you're doing, whether it's legal or not. And the second is financial, wherein the focus is more on the financial numbers, the compliances, or whether all the compliances are up to date or not.
So you very well explained about the due diligence, but what goes in this process? We want to understand that as well.
So typically a due diligence process start when the incoming investor, they appoint advisors to help them do this due diligence. There could be two type of due diligence advisors. One would be legal, who are lawyers, and the second would be a CA firm specializing in such kind of transactions. It starts with those advisors giving a list of questionnaire to you, which as an investee company you're required to fulfill and give it to them. This process continues multiple times because whatever you are sharing with the advisors, they might come back with additional documents or additional queries based on that. So that process takes a lot of time for you to understand what the advisor want to understand, to make them understand, and from advisor's point of view, what they understand about the business. So that's why this process takes a lot of time.
Can you give some idea on how much time it takes, like 1 month, 2 months, 6 months?
So typically a due diligence process would take 45 to 90 days depending upon the business. And it's also important to understand where the due diligence is coming from, what is the objective of due diligence. So to reduce the time, what you need to understand is the objective behind that question being asked and be prepared of what could be the follow-up question, right? And be prepared with that. So that would help in reducing this time frame.
With that, I have another follow-up question. Like, what are the red flags while doing a due diligence from an investor's perspective? What are those red flags?
Red flag would be your statutory dues are not being paid, right? So for example, a TDS or a PF or a GST, those are not being paid on time. That is the biggest red flag for any investor, incoming investor. And obviously then there are various other things which an investor want to look at. How your receivables look like, how your balances are there in the balance sheet, what your legal contracts say about certain businesses that you're doing. So all of that are big red flags. I want to share an incident. So I was reading an article about one of the startup companies. They had everything locked up, and during the due diligence, the auditors identified that they had certain PF dues which are outstanding, right? And that led to a huge reduction in the valuation of the company that it was being raised on. So that those statutory dues, as I mentioned, those are really very big red flags for any incoming investors.
So I have another interesting question, and I am personally interested in this question. Like, how founders who are raising money for their startups, for their companies, can prepare themselves whenever they are going for this funding round?
Interesting question, Megha. So fundraise is a long process and it doesn't really start from once you start the due diligence process. From a founder's perspective, it starts much before that. They have to be mentally prepared of what kind of valuation they're looking at, what kind of dilution they're expecting, right? And once you are sitting across a table with the potential investors, there are a lot of negotiation which happen on what kind of rights an incoming investor would have or not have. So uh, a promoter or a promoter should be ready with all those things in his mind, at least, that this is what we can do away with, and this is what we really need to have in our control.
Do you remember any incident where a startup impressed you with its preparation or any story around it?
So not about any other startup. In fact, during our current fundraise, right, I'm really impressed with our founder Nikhil, right? So he was very clear on certain items that this particular thing we cannot live without, or we cannot give away this right. So he was very firm in those discussions with the potential investors. So I think, and eventually it worked out in our favor. So that's a pretty admirable thing which we did, which we could manage.
Thank you so much, Ankit, for that insightful session. I hope, guys, it was insightful for you as well. And in the conclusion, we can say that whenever these funding round goes on, the number one thing which is important is transparency and discipline. You should be very transparent with your values, your accounts, and everything, right?
Yes, true, Mega. I think transparency is one thing which is very important. And when I say transparency, it includes in all form, right? In the data that you share, in the information that you provide, in all your interactions, you are being very transparent. So that's a really important trait to have while negotiating a fundraise or a due diligence.
Thank you so much, Ankit, for taking your time again. And it was very insightful session.
Thank you, Mega. Always happy to be here on this show. Thank you.
So guys, I hope it was an insightful session for you as well. If yes, then hit that like button and share this video with your friends. And don't forget to subscribe to our channel, which is Grip Invest. Investments in debt securities are subject to risks. Read all the offer related documents carefully.